Today we focused on the conceptual framework. We focused on the conceptual framework, and then we agreed that the conceptual framework was prepared, or is a document that is prepared by the ISB. So the ISB stands for the International Accounting Standards Body. So this is the body that's responsible for accounting in the whole world. It's called the ISB. So they are the ones who updated the conceptual framework in 2016. Sorry, in 2018. And then they are also the ones who prepare what we call IFRS. So IFRS, these are principles that are followed in accounting to help us record different transactions. So the conceptual framework is, I think, it's the mother of accounting. So when I say it's the mother of accounting, it's where the foundation of accounting is defined. Things such as the accounting equation, the objective of financial reporting, and so on. They are there on the conceptual framework. And the focus of Tuesday's class was really the objective. That's what I wanted you guys to get from the class. The objective of financial reporting is to report back to Bombreki. So we are trying to report back to the people who provided funds to the business. Remember, I told you that in accounting there's this concept of accounting equation. So accounting equation simply tells us that the assets that the business owns, which is the resources now that the business has control of, and they were bought using equity and they were bought using liabilities. We defined equity, or we said equity is things such as capital. Capital is money that is contributed by the owner or the owners into the business. And then we said liabilities, these are obligations that have to be paid back. So when I say it's obligations, it's a kiskoloto. So it's what needs to be paid back at some point. So these people, they borrow us funds, and then these ones, equity, the investors, they invest funds in the form of capital. So all those funds are used to buy what? Are used to buy assets. And so if those funds are used to buy assets, so the people who provided equity, we call them investors. And the people who provide liabilities, we call them creditors. And we can also call them payables as well. So when we prepare financial statements, the primary users or the primary people that we are trying to create or prepare these reports for, it's these people. That's why the conceptual framework specifically states on the objective of financial reporting to say that we are trying to provide information that is useful about the reporting entity to existing and potential investors, lenders, and other creditors. And so these are the people that we are trying to report to. The conceptual framework specifically states that these are the people that we are trying to report to because these are the guys who provided equity. The investors provided equity to the business, and then the lenders and other creditors, they provided what? They provided liabilities to the business. So since these guys have a vested interest into the business in one form or the other, we have to report back to them about how we are managing the resources, which is money, about how we are managing the resources that they have provided to the business, be it in the form of an investment or be it in the form of a loan. I hope it makes sense, guys. So we are going to pick up from this discussion then in today's class, since we understand the primary objective of what we are trying to do in accounting. And then I explained as well that the objective, if you want to look at it in layman's terms, is that we are trying to convert raw data in the form of daily transactions that happen each and every day in the business. We're trying to convert or process that raw data in the form of transactions or to information that is useful to the people who have provided funds to the business. These are existing and potential investors and lenders and other creditors. So another way to look at it, you can say, or in layman's terms, you can say the objective of your accounting is to do what? The objective of accounting is to convert raw data in the form of what? In the form of transactions. So we are converting this data. So there's a process that this data has to go through before it becomes what? Before it becomes information. So this information, it needs to be of specific type. So we say this information needs to be useful. Sorry. So we say this information needs to be useful. But what does it mean when they say information is useful? So that information, it means that it must be what? It must be free from errors and omissions. So that's called faithful representation. What's happening now? Ish. So it must be free from errors. So that's called faithful, number one, which means that it must be faithfully represented. So it's called faithful representation. Hey, spelling, guys. Hey. And then if information is useful, again, it must be, or it must meet the criteria of relevance. So when we say information is useful in accounting, we are trying to say that it must be faithfully represented. So when information is faithfully represented, it means that it must be free from errors and omissions. So it means that any errors that were made must be rectified. That's why we prepare, or there's an accounting process under adjustments. And it must be relevant. So relevance goes hand in hand with the concept of materiality. So materiality is the importance of something. So the financial statements should contain all the important aspects of the financial affairs of the business, because that's the information that the people who have provided funds to the business, those are existing and potential investors, lenders, and other creditors. So that's what useful mean in accounting. It must be faithfully represented and it must be relevant. And so this is the discussion that we are picking up from the class that we had on Monday. And today I want to focus more. I'm going to focus more on the elements now of the accounting, the elements of financial statements. So elements of financial statements, we are speaking about what makes financial statements. Remember on Monday we spoke about the qualities that these financial statements have. We made an analogy of your academic journey to say the time you're in matric, the type or the qualities of your matric statement, and there had to be certain qualities of your matric statement. I spoke about the physical qualities, such as there must be a signature from Umalusi. It must be approved by the department and all those things, so that you enhance, or so that you increase the credibility of that statement. So those were the characteristics, or those were the qualities. So right now we are going to speak about the elements. So when we are speaking about the elements, we are speaking about what makes these financial statements. So guys, it's raining. I'm not sure if you can hear me. So we are going to speak about the elements now of financial statements, the elements of financial reporting. So you have an asset, then you have what? You have equity, or let's say liability. Now, then you have liabilities, and then you have equity, and then you have income, and then you have an expense. So the definitions of each of these elements, they are very important, guys, and you need to know them by heart. And so you need to know what is an asset. You need to know what you mean in accounting when you speak about the liability. You need to know what we are talking about when you speak about income. You need to know what we are talking about when you speak about an expense. And so these are the 5 elements of financial reporting, or 5 elements of financial statements. So what information, what makes financial statements, what components make financial statements? They're made of assets, liabilities, equity, and income and expense. And so these are the concepts that we are going to speak about today. And if we still have time, we are going to also try to do the accounting equation for now so that you understand it in detail. So what is an asset? So an asset, according to the conceptual framework, they say is a present economic resource. So is a present economic resource controlled by the entity as a result of a past event. So this is the definition that the conceptual framework gives us, guys, as far as the definition of an asset is concerned. So you need to understand what this means and be able to apply it as well. So when they say an asset is a present economic resource, what does it mean? And then what does it mean when they say it's controlled? What does it mean? And then who's the entity? Is the business, of course. What does this mean as a result of a past event? So in simple terms, like an asset is anything that you own that brings you income. And so it brings you present and future income, or it brings you certain economic benefits. So when they say it's an economic resource, and so they are saying that it's something that you own, and that uh, can bring you monetary value. And so when they say a present economic resource, you can say that anything that you own or control, and that brings you income or future benefits. An example of an asset, we are speaking about a vehicle that the business owns. The phone that you own, if you use your phone maybe to trade forex, or you use your phone to make money online from a master base, it means that your phone is an asset because you own your phone and you control. So control also means that you can direct the use of the phone. And so by you using that phone to answer surveys online and make money, it means that it's an asset to you. So, as a result of a past event is you buying the phone. So, if you bought the phone on credit, it means that you are paying monthly installments. And then, if you bought the phone cash, That's the past event. The day you went to buy the phone. First, you are not required to be able to go into detail in terms of proving what is an asset and all those things. And but you need to know this definition the way it is. To say an asset is anything that you own or control that has the potential of bringing you future economic benefits in the form of income. In the form of income, and then examples of assets, and it's a vehicle. So this is a car that the business uses. Other examples include maybe land that the business owns, the buildings, and cash. And also these are the examples of assets that the business can own. And there's also more, and they are not limited to these ones. Let's go to the next one. I hope you understand, guys. Let's go to the next one. What is the liability? And so the conceptual framework is saying that is a present legal obligation or the present obligation. So this is a present obligation of the entity. And so this is a present obligation of the entity to do what? To transfer economic benefit or economic resource as a result of past event. To transfer an economic resource as a result of a past event. So guys, a liability, you know it, and just like an asset. So that here they're using different English to define what is a liability. But your basic understanding of a liability is that a liability is koloto. And when something is a debt to you, it means that you have an obligation to do what? To pay back. So kiskoloto today, that's why they say here is a present obligation. So a present obligation is a responsibility that you have, kiskoloto, of who? Of the entity. To do what? To transfer an economic resource. So we say liability, in other words, kiskoloto is a debt that you have as a business right now. And then this debt, because you are owing someone, you have the responsibility to pay them back what is due to them. So that's why here they say that it's a responsibility to transfer an economic resource. So this economic resource, they mean it can be money, or you can pay maybe in other assets as well, or maybe you can use assets to pay this present obligation. And, uh, and then they say it's as a result of a past event. The past event was you going to borrow this money from this person. So when you borrow money, that's the event, and then that causes the obligation or the responsibility for you to pay back the money. And so that's a liability in simple terms, guys. It's just that here they used different English. But if you know that the liability is koloto, then you're done. What happens, koloto? Koloto is something that you have to pay back at some point in the future. So that's how I can define it. So that's why they say the present obligation is the present responsibility of the entity. What is this responsibility? The responsibility is to transfer economic benefits or an economic resource as a result of a past event. So even with this one, guys, you are expected to know this definition. You must know it. If they ask it on a test, you must be able to write it exactly the way it is on the conceptual framework. First year BCom, you are not expected to use this definition, or you are not expected to apply it. But if you're doing BEC, you were going to apply this definition in terms of you would have to prove that a certain resource is an asset or a liability and all those things. So you'd have to prove. But you're going to do it when you're doing second year. And then the next one. We are talking about equity. So for you to understand the definition of equity, it's a bit tricky. So we go back to the accounting equation, which states that A is equals to E plus L. And then if you rearrange this accounting equation and make E the subject of the formula, and so it means that it's going to be E is equals to A minus L, and so A minus L, so the difference between assets and liabilities, it's what's going to give you equity, and the difference, so it means that the difference is what is left under assets when you subtract what? When you subtract liabilities. That's why now the definition of equity is saying that equity is the residual interest. And then, it's saying that is the residual interest. The definition is saying that equity refers to the residual interest. And then where is the residual interest? Where? In the assets of the business or of the entity and then after all the liabilities have been paid. And then, so equity is the residual. So what does the word residual? It's what is left. What is left? Okay, guys, we have 10 minutes left, and so we'll continue. But when it ends, and then I'll send another link as well. So as I said, that residual interest, residual means that it is what is left, and what is left. So what is left? Where? I said, Mina, if you rearrange this formula accounting equation, it's going to be E is equals to A minus L. So A minus L is the difference or what is left in the assets after you removed all the liabilities again. So that's why the definition is saying it's the residual interest. Residual interest is what is left where? In the assets of the business after you have removed what? After you have removed all the liabilities. And then, so if you forget the definition equity, you can use now to remember. You can use this thing that I spoke about here to say rearrange the accounting equation. And then start here. A is equals to E plus L. And then when you rearrange the accounting equation, make E, and you are trying to define equity, make E the subject of the formula. It means that you'll take this side, or let's say you'll take okay, you just take this one. You'll take this side so that you remain with E. So it's going to be A minus L. So when it's like this, assets minus liabilities give you equity. So this in words, it means that it's what is left in the assets of the business after you have removed the liabilities. It gives you equity. That's why the definition here is saying that is the residual interest in the assets of the business or of the entity after all its liabilities. And then, so this is equity. When they say define equity, that's the definition that you are going to use. And then at first year level, you just need to know the definition and you want to apply it. And then we are going to go to the fourth element. So the fourth element is income. So income is an increase in what? Is an increase in assets or decreases in liabilities. And is an increase in assets or decreases in liabilities. And that does what? That results in an increase. That results in an increase in what? In an increase in equity that we've just spoken about. And other than This last part is very important. Other than those relating to contributions. Other than those relating to contributions from holders of equity claims. Okay, so this thing in simple terms, guys, in very simple terms. And then income is anything that brings in money to the business. And then, so when you receive money, that's income. It's money coming in. And then, so this money coming in can result in what? Can result in an increase in assets. So, for an example, when someone pays you cash, it can result in an increase in an asset called what? Called bank. Okay? So the money that you have in the bank is going to go up. Or this income and it can result in a decrease in liabilities. So this income can decrease the liabilities or the skoloto that you have with someone else. For an example, if maybe Skolile owes maybe Oyama, for an example, and if Skolile owes Oyama, for an example, and then Oyama, for an example, owes let's say Utshegofatso, for an example, and because Utshegofatso is a liability to Oyama, and me, instead of paying Oyama, I can pay the liability yaga Oyama, which is Utshegofatso. So income can result in an increase in an asset, or it can result in a decrease in what? In a decrease in liabilities. And that results in an increase in equity. So income results in an increase in the residual interest of the business. Remember, equity is the residual interest in the business, in the assets of the business after you've deducted all the liabilities. And then, so and this income excludes any money that comes from the people who own the business. So any money that comes from investors, for an example, it does not form part of income. That's why we call it a equity. That's why we call it capital. So the money that is contributed by the owners does not constitute income, is not income, and it is equity. And so income is any money that is generated by the business as a result of operations. And so this money can result in an increase in assets, or it can result in a decrease in liabilities. Either way, this results in in an increase in the equity of the business. But this money excludes monies that come from the people who are equity holders. So it excludes money that comes from the people who have invested or who are investors to the business. So that's equity. So if you understand equity, it's easy to understand expense. So the expense is the opposite. Expense. So instead of resulting in a decrease, in an increase in asset, expense results in a decrease in assets. And then it results in an increase in liabilities. And then that results in a decrease in assets or an increase in liabilities results in what? It results in a decrease in equity. And other than those relating to instead of distributions, instead of contributions, sorry, here we are speaking about distributions. From holders of equity claims, or to holders Income is the opposite, or expense is the opposite of income. If uyibambe kanjalo, you'll be fine. So an expense is a decrease in the assets of the business, or an increase in the liabilities. So when you pay someone, when the business pays someone, for an example, or when it pays an expense, it results in a decrease in what? In the assets in the form of bank, because you paid cash. And or you can pay, or you can buy an expense using a liability, which means on credit. So when you buy an expense on credit, it means that you are increasing your liabilities. That's why we say it's a decrease in assets or an increase in liabilities. That results in a decrease in equity, which means that results in a decrease in the residual interest of the business. So when you pay an expense, you are reducing the wealth of the business, which is the residual interest. But this excludes now money that goes out as a result of distributions made to holders of equity claims. So what does this mean? This means that anything that is drawings, so when the owner takes out money from the business, that money is excluded in the definition of what? Of an expense. Because an expense, we say that is anything, or it's money that goes out of the business as a result of the operations of the business. And then that money goes to the. Let's continue, guys. We say that an expense is what? An expense, we said, is a decrease in assets. And or an increase in liabilities. This decrease in assets or decrease in liabilities, if either of these two things happen, it results in what? That results in a decrease in equity, other than distributions, other than distributions, other than those distributions relating to holders of equity. So we say that equity, or an expense, is a decrease in assets. Remember the accounting equation. So equity either decreases assets or increases liabilities. Expenses, they either decrease assets or increase liabilities. So when there's a decrease in assets or an increase in liabilities, this results in what? This results in a decrease in equity, and other than those distributions relating to holders of equity. So this means that equity, in simple terms, is money going out of the business as a result of business operations. So what does this mean? When the business pays for an electricity, cash, that's a decrease in assets because it's a decrease in cash. And when the business buys, for an example, they buy electricity on credit, that's an increase in liabilities. So these two things, they result in a decrease in equity because they make the business less richer, or they reduce the residual interest of the business. And then, so this money going out it should exclude money that is going out to the owners of the business. The money that is going out to the owners of the business, those are drawings. So they are excluded in the definition of an expense. So that's why here they are saying other than, except those distributions, those monies going out relating to holders of equity. Holders of equity, those are the owners of the business. If you understand these guys, the elements of accounting, you are proper. You are proper. So is an asset, liability, equity, and an expense. And the financial equity, income, and expense. The financial statements, they revolve around these 5 elements. They are made of these 5 elements. And it's asset, which is a present economic resource that the business owns or controls as a result of a past event. That's an asset. A liability is a present obligation of the business or of the entity. And so when something is an obligation, it means that it must be paid back at some point in the future. I elaborate more, of course, on these terms on the study guide as well, by the way. If you are interested on the study guide still, I elaborate more on the study guide. It's going to make things easy for you. So these things that I'm explaining here, I'm explaining them on the study guide. So if you have the study guide, you won't even have to make the notes. So is a decrease in assets or the liability is a present obligation of the business as a result of a past event. Okay, so this obligation requires you to transfer an economic resource. And then equity is the residual interest. So equity, it's what is left in the assets of the business or of the entity after deducting all the liabilities. And then income is anything that results in an increase. It's anything that results in an increase in the assets of the business or a decrease in the liabilities of the business. And then so this results in a decrease or in an increase in equity other than contributions relating to owners of or holders of equity. And then the expense is the opposite. And expense is a decrease in the assets of the business or an increase in the liabilities that results in a decrease in equity other than those distributions relating to holders of equity. So these were the 5 elements of financial reporting, 5 elements of our financial statements. You need to know all these definitions, guys. And those who were doing accounting last year, they know. Sometimes they ask one of them in a test and it's 5 marks. It's 5 marks this thing most of the time. So you need to know each one of these definitions one by one. And so we are done now with the elements of financial reporting. I'm going to go back to the accounting equation because it's the foundation, guys, of accounting. So if you understand the accounting equation, you'll be fine. So as an entrepreneur, when you start a business, you start the business with the objective of generating a profit. We understand that. You can't start a business just for fun. You want money. But sometimes you discover that these entrepreneurs, they don't have enough capital to start their business. You are always talking about the startup capital. When they ask you, why don't you start a business? Maybe against Amazip or your peg or something. Calling startup capital, which you don't have the money to start the business, or you don't have enough funds to start the business. And then, so the money that you contribute as the owner, so this money comes from the investor or the owner, and it's called equity or falls under equity on the accounting equation. And the monies that come from the people now who have borrowed you funds. Let's say now you go out, instead of complaining that you don't have enough funding, you go out and borrow money from your friends. That money that you've borrowed is called liabilities, and you must pay it back at some point in the future. Is a present obligation that the business has. So since you must pay this money back at some point in the future, you have an obligation to transfer an economic resource. You have a responsibility to pay it back. So it comes from lenders plus other creditors. So after these people have provided you with the funds, now you have the money. Now you have the money to buy the assets that you need. Why do you need these assets? You need these assets to achieve the objective that you had from the first place, which is to do what? Which is to generate a profit. And so, in other words, you can use this money to buy trading stock, from an example, and then from the trading stock, you charge a markup price so that you make a profit there. So the accounting equation is very important in accounting, and when you understand the accounting equation, you are going to be fine. And you won't have problems, guys. You are going to be fine. And then just to explain another way, so that you understand, so that you remember the 5 elements of your accounting, let's do this. And we have already explained that an asset is a oh we have already explained that an asset is a present economic resource, and is a present economic resource that is controlled by the entity as a result of a past event. And then equity, we said that it's what is left in the assets of the business after deducting the liabilities. Okay? And then under equity, I say that, for an example, for me to classify them properly, you have equity as a result of business operations. So this is your income and expenses. And then this is now equity as a result of owner's involvement in the business. The owner's involvement in the business. Involvement in the business. So here you are speaking about what? Here you are speaking about capital that is contributed by the owners or drawings. And so remember, the definition of income is saying that is an increase in assets or a decrease in liabilities that results. The net effect of income is that it increases what? It increases equity. That's the net effect of income. It increases equity. So it's an increase in the assets of the business or a decrease in the liabilities of the business that results in an increase in equity. But this excludes money that comes from the owners of the business. So it excludes, that's why it's saying other than contributions that are made by holders of equity. So it excludes money that comes from the people who provided equity to the business. Same as liability, same as expense. So this equity that happens as a result of the business operating. So an expense is a decrease in assets or an increase in liabilities that results in a decrease in equity. And then so income results in an increase in equity. It makes the business more it makes the business richer. It increases the residual interest of the business. And then expenses, it reduces, so it's taking away from the business. Income, it's giving into the business. Expenses is taking away from the business. And then equity that happens as a result of the owner's involvement in the business, it's this one. Capital, which was excluded in the definition of income, and drawings, which was also excluded in the definition of an expense. And because the definition of income is saying that excluding contributions relating to holders of equity. So there they are speaking about capital. A capital is a contribution that is made by the person who invested money to the business. And then same as drawings, the definition expense is saying that other than the distributions made to holders of equity claims. So distributions, those are drawings. So that's money going out to the owners of the business. Those are drawings going out to the owners. So once you understand these guys, you'll be fine. So this is your 5 marks for this year. And then test 1, you are going to have one of these on the test. So you need to be ready. Make sure you understand the definitions. Make sure you can remember them. Make sure you can write them properly. And then I've explained them in different ways, so that when you have to memorize, when you have to remember those things, at least now you have attached a meaning to those things. You can't memorize what doesn't have meaning to you. That's why you are able to memorize maybe your date of birth, for an example, because it has a meaning. It's usuku lakho lokuzalwa. So you can memorize it because it has a meaning to you. So even these things, the only way you can memorize them and remember them is once they have meaning. And if you understand them and they have meaning to you, it's going to be easy to memorize and be able to write these things when they ask them. And so today, guys, we are going to end here. And thank you very much for those who attended. If you have questions, you are free to ask here or on the group. But guys, with this level of consistency and dedication, if you can put in the work for the whole semester, and I promise you, there's no reason for you not to get distinctions in accounting. And it's not going to be easy, of course, because there's a lot of work to cover, especially first semester. But I promise you guys, you'll be fine. Make sure that you have a book, a notebook, where you can write my notes, or you can buy a study guide. And these things that I'm talking about, they are there on the study guide. I've explained them thoroughly. Make sure you have a notebook or you have the study guide, so that you just add your own notes on top of the study guide. And then make sure that you have a practice book, accounting. Practice all the questions that are on the study guide and check if you understand. If there's something that you don't understand, you can come to me, or you can go to Dave if he's still responsible for our first year. But I just wanted to say, guys, there's no reason for you not to pass well accounting with this level of dedication. If you can work together and make sure that you push each other, you're going to be fine. In fact, you're going to fall in love with the module as well as time goes, given that now you can understand it properly. So thank you for those who attended today. We are going to see each other next week. And yeah, good luck, guys, for the semester. I know it's not going to be easy for you, but good luck, all the best. Please work very hard, and please take care of yourselves, guys. Thank you.